Hey guys, welcome back. Today we're going to talk about four what I call intermediate mistakes. Okay, so intermediate in terms of complexity and where you will be in your investment lifetime when you might suffer from these or as you might suffer from these. Typically, these aren't beginner mistakes. They might be, but usually it's a bit later at the intermediate stage of your investment career. And so here's one that happens to the best of us, sometimes without even realizing it over time. It's over concentration in certain stocks or markets. So let's say you buy an S&P 500 fund, index fund, and then you also buy some tech stocks. Well, you might have some redundancy there. So if you have Google and Facebook and Amazon, you might have them twice. So you're double exposed and you're overly concentrated, in this case, probably on tech. Now, it's not necessarily bad, especially if you're thinking that those stocks will outperform, but you might be working against yourself in terms of diversification. The same thing can happen on a sector. So if you think the energy sector is going to have a boom, you start finding opportunities and you start acquiring, and all of a sudden you've shifted your portfolio a little too much on one particular sector or another. And then sometimes you just have that unicorn winner, say you bought Amazon in 99 or something, that really skews your portfolio ratio because they went up so much. So the value of the portfolio just kind of starts being unbalanced or over concentrated. So those are things you watch out as you grow your portfolio, just to keep an eye on, and don't accidentally over concentrate when you think you're actually diversifying. Owning stock you don't want. So this will happen sometimes because you approach investing not from a long-term strategy, but from a short-term profitability point of view. So you might end up with too many funds that either overlap or are not in your best interest. So I know people who have, let's say, an index fund for half of their portfolio, and then a couple of actively managed funds to try to beat the market. But within those active funds, they may not have the stocks that they want because they're active. One thing that happens a lot, let's say ESG, right? Environmental, social, and governmental responsible companies. Uh, you might end up with a company that is socially and governmentally very responsible, but not ecologically responsible in an ESG fund, or vice versa. So the three are not actually, you don't have to coexist or be there on every company. So if you might be in an ESG fund and find companies that you don't want at all. So watch out for that. You might end up owning companies you don't want. Third, confusing risk tolerance for risk capacity. This is an interesting one. It's very subtle, but occasionally there's a recency bias for us. And so if something starts falling, we might lock in a loss and stop the downward momentum, if you will, on something because of the recency events. You can take Boeing actually right now. I'm not saying this is a time to buy or Boeing or not. I'm just saying recent events on Boeing's timeline have not been great. The stock has suffered, will probably suffer more, and that may cause some people who were holding it to liquidate it, and that's okay. But reducing risk appetite is during volatility is not the same as your risk capacity. And what I mean by this is your risk capacity is more so dictated by your timeline horizon. So you can take short-term losses and lock in much better long-term gains if you're not paying attention to the recency bias. Again, not saying Boeing in particular, but they do happen to have some recent shortfalls. They've stumbled for sure. So don't confuse your risk capacity for your risk tolerance. The two are not quite the same. You can be intolerant of risk, but if you have a 30-year ramp ahead of you, does it really matter if they're down 10, 20% for a few years? Probably not. Um, Next is paying too much. And at some point, for some reason, we seem to kind of lose focus on real value, especially when working with funds, whether they're indexed or managed, because they have so much in them, and the price tends to be shifted by who's buying or how much they're buying, and that may drive the prices up or down. And they're completely uncorrelated to the actual value of the companies contained within. So they are great at the low cost management for the most part and to diversify, but you do have to kind of uh, not limit yourself to just them, because then you're also putting a cap on your total possible return. And so you might end up seemingly paying too much for a low return, whereas you can have sent a little bit of your funds to something else that might have been better priced at that moment and might yield higher than the average 8 or 10% that an index fund would yield. So, and even active managed funds, uh, I'm not a big fan. About 10% of these fund managers can actually beat the market. Uh, if they'll charge you much more in management fees, and if they lose money, if it goes down, uh, they're still charging you. It doesn't matter to them. So I find that an unaligned interest, and I'm not a big fan of the situation. So anyway, these are four intermediate, I'm saying mistakes. Maybe that's a bad name for it, but four intermediate investment things to look out for. Thanks for watching, and please subscribe.